Hello and welcome back to the Adventures in CRE audio series. Today, we are talking about metrics to live by and having a plan of action for multifamily in a post-COVID world. Let's get started.
Welcome to the Adventures in CRE audio series. Join Michael Belasco and Spencer Burton as they pull back the curtain on everything commercial real estate and introduce you to some of the top minds in the industry. If you want to take your skills to the next level and be part of a growing community of CRE professionals across the world, this is for you.
All right, welcome back to the audio series, everyone. Today, I'm joined by the ACRE team, Michael and Spencer. Say hello.
Yeah, good to be here.
And we have a special guest with us, Lane Bean. And as far as the introduction, I'm going to kick that over to you, Spencer. Let's get started.
Yeah, so I'm happy to introduce a friend and someone who makes me a better professional. So they say that you are a product of the people who you're surrounded with, and I found that anytime I interact with Lane, both on a personal and a professional level, that I come away a better professional and a better person. And so I've been looking for an excuse to get Lane on the audio series, and given what's happening in this post-COVID world and Lane's experience in the space, I thought he'd be a really good fit. Now, some background. Lane is a former Air Force pilot. He's an F-16 pilot. In fact, at one point, he invited me and my kids and my wife out to his base, where we saw these F-16 planes taking off right in front of us. I mean, we were out on the runway. You could feel it in your chest as these things fly by. Well, he flew those for 28 years, a retired lieutenant colonel in the Air Force. And so just an upstanding guy. Now, what's fascinating about his story is some 15 years ago, so he was an Air Force pilot at the time, somehow begins investing in real estate. And he started with single family houses, pivoted to multifamily, has built a portfolio for himself of 700 some odd units. And when you talk to him about his investment strategy, I mean, he cares as much about his tenants as any operator I've ever met. And so I wanted to get him on, especially now that he's retired, and we can really take advantage of his expertise and hear about what he's doing at his properties to help his tenants in the environment that we're in, and then think about metrics that matter now that maybe matter more today than they might have 6 weeks ago. So anyway, Sam, that is Lane. Lane, did I miss anything?
You covered most of it, Spencer, so I'll fill in the details as they become applicable.
Okay, great.
Very good. Yeah, so we're really excited to be here today. These are interesting times we live in, and everybody is adapting. And, we're all making plans. We're all doing our best. So I think maybe, Spencer, I'll kick it back to you to kind of set up we've kind of done that a little bit, but set up the conversation and maybe start where we're at as far as, COVID, multifamily, and where this kind of stuff was leading us and what plans we're making.
Yeah. So what I really want to get out of this, because this is the Adventures in CRE audio series, and so we're Excel nerds. I really want to talk about metrics that matter more than they used to. So that's one. And then the other is, and this goes hand in hand, but for the operators that are in our audience, and specifically to Lane, like what action plans are you putting in place at your properties or that matter now? And then some ideas about how multifamily investing changes going forward. So anyway, Sam, that's the setup. So maybe I'll start, and Michael can chime in here as he thinks about it, like metrics, financial metrics that matter more. So one that comes to mind is collection percentage. What percentage of tenants pay rent in a given month? And I know that we have our collection loss line item, general vacancy and credit loss line item in our pro formas. And it's always been, at least in my experience, something you've quickly moved through. 1% collection credit loss in this deal. And on you move to operating expenses. And I think especially in properties that are more impacted by social distancing and the careers around that, tracking the percentage of tenants that are paying rent, I think matters. And not just during this period. And there's probably 12 to 18 months where this thing's going to really matter as we have waves of social distancing. But going forward, I just think this is a metric that's underappreciated. Lane, do you disagree? Are you thinking about this differently?
No, I think you said it right, Spencer. Once you get a project stabilized and you have your stable tenant base, you have a pretty consistent payment. If a tenant is not paying correctly, then they generally become a problem. If they do pay well, then you generally don't have to worry about that. So your statement that that's a line item we move through quickly, I think is a very fair statement. Pre-COVID. Post-COVID, there's been so much disruption in employment, disruption in bills, and I think that's really uncharted waters. And I know that there's some government programs to help get to subsidize the loss of income, but the real question is after the stimulus package has worn off and the political resolve to continue to support the economy, and now businesses have to stand on their own and change to the market conditions that are post-COVID market. Will these businesses still thrive? Will the small businesses still employ the tenants? And will the tenants still pay? So the question you asked was, this was a line item, loss of rent or bad debt was a line item that I moved through quickly or your students moved through quickly pre-COVID. And I think that was a fair assumption on a stabilized project. But post-COVID, I believe that there probably is an adjustment to that point. I don't know what that is yet.
Yeah, in fact, in my models, I usually combine general vacancy and credit loss in one line because it was that inconsequential to my analysis. And I think separating those out and thinking about credit loss matters more, especially to your point about businesses. Ultimately it comes down to the employers for your tenants and how are those employers doing. That determines whether your tenants are going to be able to pay rent. And it's always been that way. It's not like this is something new, but all of a sudden where a quarter of the economy isn't operating, you start thinking about that. Michael, let me kick it to you. I mean, as you think about underwriting multifamily in a post-COVID world, is there a metric that sticks out that maybe matters more or less than it used to?
Well, I haven't come to a conclusion about a specific when we get to line item metrics, but you're hitting on something that will roll up, which is the larger discount rate, right? And you take a Class A building that you're discounting back, at a certain percentage, you want to hit that discount rate, or that's sort of, in your risk return world, if you're looking at a core asset, what do you discount that to? How do you, if we're talking post-COVID world, and you mentioned waves, right? And I don't have a crystal ball. Nobody has a crystal ball. I don't understand yet, and I don't think anybody does, how that will impact. But now you're pricing in so much more uncertainty, not just from the immediate present, right? Like, there's always talks about the V or the longer recovery. This could be an unstable sort of wave back and forth. And, I'm not trying to be like a doomsday sayer here, but what I'm trying to say is there's more uncertainty now because we haven't figured out, like, this is, I've heard it, you've all heard it, this is a health crisis, and we need to figure that out. And as that is the core, it's not only solving the economics, there's a bigger picture here. And so pricing that uncertainty, I know we're talking about specific metrics, but really it's the discount. How are you pricing these? I think that's really, I hate to be so generalist. That's really the big question here, but that to me is obviously the ultimate. Like, how are we pricing? How are you projecting cash flows? Just projecting revenue, projecting rent. And you hit it. I mean, you kind of hit it. Maybe we're saying kind of one and the same thing, but.
Well, no, I think that's something else, right? So discount rate is synonymous with return, and return is a proxy for value. Right. And so if there's less certainty, discount rate or your target return is higher, and a target to yield a higher return, you must pay less for a property. Yeah. And
which rolls up from the your collection. What's the collection percentage? How are you projecting that? What are you going to discount that back to? No, it's true. They tie together.
Yeah, which what we're saying is, and I agree with you, by the way, we think multifamily is worth less today than it was worth 30 or 45 days. So yeah. Lane, have you gotten any market intel around valuation in multifamily? And have you seen any, do you have any anecdotal evidence that pricing is falling? Because right now, I think Michael and I are just hypothesizing that values are lower than they were.
Absolutely, Spencer. And let me give you a very specific example. The days leading up to the first news report, the national U.S. news report of the impact of COVID, and this was about 3 weeks ago. I believe this was about the 14th of March. I had a property in Denton, Texas, North Texas, that was for sale. And we were trying to position it, and it was lined up for call for offers, which is basically like the final step of the sale. And we had 9 groups interested in making an offer for purchase on this project. And they were coming in right at the purchase price that we were anticipating, or at least that was the rumor of that. On Thursday is when the first news report of the national impact of COVID occurred, and it started to unwind. And then on Monday was our call for offer, which is basically like the last, hey, send your offer in and we'll consider it, for your audience who's not familiar with how the commercial sales process works. On Monday, that was the worst day of the stock market since the entire century. And I believe that was the 17th of April or the 17th of March. That day, it was a 20% decrease in value from Wednesday, where we were projecting these offers and the broker was reaching out. What are you expecting the offer to come in? On Monday, it was almost a 20% decrease. And a lot of those offers just completely eroded away. There were no offers at all. So over about a 3-day period, our value dropped by 20% of our project. And then I've also seen that consistent across the whole commercial spectrum. Multifamily has probably dropped or devaluated about 20% for the reasons you, Michael, and Sam were talking about, the lack of consistent, durable income streams.
Yeah, yeah. And you could argue that multifamily is one of the safer of the property types still in a post-COVID world. Now, industrial is pretty safe. It seems to have shown itself to be at least certain elements of industrial have proven itself to be an essential property type. And so those valuations have held up. But retail, and this podcast isn't about retail, so I don't want to go down that rabbit hole. But even with that, multifamily is still relatively safe. So any other, go ahead.
Well, I was just going to add, you said it, multifamily is an essential, right? Everybody needs to occupy housing. And the question then becomes the mystery. Okay, well, everybody's occupying, but who's paying, right? And there's expenses, and that's where it becomes really interesting, right? Because it is an essential. Whether people can pay for it or not, they're not going to leave. I can't imagine the mass wave of people who can't pay rent getting evicted, and then all of a sudden I'm not saying anything people haven't already been thinking about or talking about, but I just want to call that out. Is it safe, or is it more costly because the occupancy is happening? There's occupancy costs and all these associated costs that go along with an essential piece of real estate that may not have a revenue stream.
Yeah, but that's true. I mean, what you're saying is there's fixed costs there that irrespective of your occupancy, you're going to have to cover, where maybe in other property types that NUD is lower. Let's talk about another metric, and then we'll get to the operating side, because that's really where Lane shines. So the other metric that I thought about that matters more is break-even occupancy. It's a metric that sometimes you see in models and sometimes you don't. But in this world, I think it's really important to understand at what occupancy level do I break even? And that break even includes debt service coverage. And so maybe we cared about it before a little bit. I think it matters a lot now. And maybe it's not break even occupancy. Maybe it's break even tenants paying, right? Occupied tenants who are actually paying rent.
Maybe there are new metrics that come out of this. Right? We're in a new paradigm, right? And maybe there will be metrics that come up with, and maybe Spencer, you'll be the one to.
Yeah, it's almost like a RevPAR metric, right? Where these are available units, but are we getting any revenue on them? Yeah. So anyway, that was the other metric that had come to mind for me. Any thoughts on that?
Yeah,
Spencer, I think that was something that I've heard of, and of course I know what it means. But in light of the last 5 or 6 years in the market, that was just such an underlying metric that I don't know if many people even talked about it. I mean, it's a fairly simple thing to understand, but it just wasn't really part of the vocabulary or in the dynamics. Because if it was that close, you just didn't do it. Even on value add or even on deep repositions, break even occupancy or break even revenue wasn't something that was talked a lot about in financial metrics.
Yeah. And so I'll be sure to include both that metric as well as the collection loss metric in the write up to this episode. And that way people can go find the definition and learn how to calculate those metrics. So Sam, if it's okay with you, I think we should move to kind of the operating side. Like, Lane, go ahead.
Hey, I got 2 other ones, Spencer, that I was thinking about when you and Michael were talking there.
Sure.
And just real briefly, let me hit these because I think they are very important metrics in light, and they have changed in light of COVID. And that is the rent growth, because as I was pro-forming and I was developing a forecast for financial models, one of the biggest things was rent growth. And I think post-COVID, it's going to be difficult to project a very healthy rent growth. Generally, based on the property, you would have 1% rent growth, maybe up to 4% rent growth in some projects. And I just don't know if that's consistently healthy. So rent growth was one, and the other was vacancy. Can you imagine showing a property or showing a unit now and you're in stay-at-home orders? How are you going to do that? And so the vacancies are going to be, I think there's going to just be harder to fill because there's going to be fewer people out foot traffic, and that's going to result in, higher vacancies. The turn time between down units is going to be higher. And so those 2 metrics are operational things that I think you will see increase to the detriment of operators and to the detriment of investor returns. So those are 2 other ones that I thought about in addition to what you mentioned.
I think that's true. The vacancy piece, you have a short-term element to that. Over the next 12 to 18 months, totally, it'll be harder to show units, and therefore units will be down longer and your overall vacancy. But long-term, if we go into we're in a recession. I think that's universally agreed. If we go into a deep recession and this has a structural impact on the economy over several years, underwriting a 5% vacancy in a stabilized pro forma may not be right anymore. And maybe it's 7 today. And I've seen co-stars drop their vacancy or increase their vacancy projections on almost all submarkets that I've been looking at. And so if we're talking long-term vacancy, I'm assuming we're going to be underwriting something higher than what we did 2 months ago. And then, rent growth is a similar issue. Short term, there's no rent growth, and even in the midterm, you assume there's muted rent growth for the foreseeable future. So, good insights there. On the operations side, Sam.
Yeah. So I think understanding how to model deals that you have, model deals that you might have been looking at wherever. I think we've kind of covered that. What now is important to integrate into these equations. Now, what do people do? I mean, you own properties, whatever the case, you're operating properties. What are the action items that we should be taking proactively today to to perform at the optimal level, to really, a lot of people are just going to sit back and wait for things to happen. What is the proactive things that we can do? And I'll leave that up to anybody. I'm not going to kick it over to any one person. Is there anybody that wants to kind of kick us off there?
Yeah. I can start there. So we are in the business of leasing space. That's what we do. That's what commercial real estate's all about. And space use determines demand. And space use is a function of human psychology, right? We use space based on how we feel about it and what maybe economic abilities we have. And that influences how we use space. And so when we use that lens to look at multifamily, how does multifamily use change? Now, I really want Lane to talk through. He has this kind of 6-step plan that he's been using in his properties, and I want to get to that. But me, who I don't operate multifamily on the front lines like Lane does, so this is very simplistic. But one thought I have is that if I'm an operator of multifamily, my tenants are probably going to be in their units more than they have in the past. A lot of them working from home. And so how am I supporting that use, that behavior? And it could be everything from offering free, fast internet, reliable internet, or it might be a new revenue stream where I offer a fast guaranteed cable internet that is at a discounted rate, but I still earn something on that. And there's a little revenue generator that I didn't have before. So that was one. Michael?
Yeah, so you hit, there's two space, well, there's probably more than two spaces, but there's the individual family or person's unit. And then the other issue, which I think is the most challenging, I'm really curious to hear Lane's take on this, is the common areas. You have essential areas where people need to interact, elevators, hallways, egress, all these places where, you have a 6-foot, minimum distance, and yet you don't know when somebody's out in the hallway, right? Like, and that's a real fear. Like, am I going to open the door and all of a sudden somebody's going to be coughing at me when I get out? Or if I have to go push the elevator, or what if somebody on floor 3 is getting on and I'm on floor 4? And, how do you handle that? I'm touching my buttons, all these things which seem crazy to think about, but solution wise, I don't know. Like how do you solve that? I haven't thought about, I'm not in the multifamily space that deep, but how do you think about that? It's funny. I must have been on some website. I saw somebody with a lighter and like a safety pin on the tip of the lighter, and he pushed the elevator button and then he'd flick his lighter on and you saw him sanitize. It's just like little funny things. It's funny, but it's like, that's actually kind of a good solution for this.
Yeah.
So, common area spaces, is there like sanitizing? Are you offering, maybe there's scheduling, right? I don't know. Like, everybody can kind of share this. I have no idea. I haven't thought deeply about it, but there are going to be some really great creative solutions. And I wonder if Lane, if you have thought of any. I'm sure you're thinking deeply about all this stuff, but I'd love to get your take or your thoughts on that.
Well, certainly, this crisis has put the national economy and put every business, every corner store in jeopardy. And whether that's a restaurant, whether it's a dry cleaner, whether maybe with the exception of Walmart or some medical supply company, everybody's going to take a bruise from this. And apartments and apartment owners and investors and stock investors are not immune to that as well. So when you ask that question, Michael, is how do we get through this with no broken bones? How do we get through this and survive? And what procedures do we have to endure to get through it safely? And then what procedures will stick after the crisis is complete? And I don't really know all the answers to that, but let me kind of real briefly, without making you guys experts in operating multifamily, what we're doing. Well, in any situation like this, where we've already talked about the restrictions to cash flow and restrictions to revenue, there's 3 things an apartment owner needs? Cash, cash, cash. Okay. We need a cash cushion so that we can absorb all of these unknowns, because that's really what it is. Who's going to be able to pay? Are they going to be able to pay next month? Is their job going to be terminated? Is their unemployment benefits going to stop? So we need that cash. And so we've got a crisis action plan that we implemented immediately. And it's 5 or 6 steps, pretty much stop all repairs that are unnecessary, stop investor distributions, line by line audit, things that you would normally do in your household budget, and you probably are doing in your household budget, to just try to save cash for, that day that you don't know what's happening tomorrow. So I can go into more detail if you want to, but basically that's our process at each apartment complex that I participate in, is to save and preserve cash so that we have that margin, so that we can, like Spencer said earlier, our break even number, if we start getting close to that, now we have a margin or a cushion that gives us more risk mitigation. So that's really kind of what we're doing. I could go into more details on how we do that, but essentially the plan's purpose is to preserve cash while still providing an adequate level of service to our residents. We've had to change that, not necessarily to save cash, but primarily to try to put protocols in place so that we protect their health and they protect our health, while we're still trying to figure out who's got this and who doesn't. Like you see at the restaurants, you can't go in now because you don't know if they've got it or you've got it. The same sort of idea with the operating, maintenance, and repair of apartment complexes. So that's kind of a synopsis umbrella of what we changed.
So what do you do about common area? Let's imagine you have a swimming pool. Do you close that?
Closed. Yeah. Okay. So we're following the the National Apartment Association, the County Apartment Association, and their recommendation is basically to close those, because you can't group together anyway. They would all be grouped out there, and so that would be a violation of ordinance. And so most of those, Spencer, are closed.
Now, for how long? All right. So imagine a scenario where we all leave our houses, but we know that we'll have flare-ups of this thing for some time until a vaccine is in place. Do you limit access to those common areas at some point? Have you developed a plan yet for what those next steps are?
No, I think we pattern what the government does. So when the government allows the restrictions for business to be lifted, and the city allows the city pools to open and the parks to reopen, I would assume that would be an indication to say, hey, it's now safe for you to have an outdoor barbecue at your picnic-like or your park-like setting or your pool-like setting. If the city pools were open, I would think that would be indicating that because I don't have access to the medical, documentation, medical experts like the mayor would or the governor would. And so I'm just going to lean on them and trust that they are referencing the breakout, the hotspots, the number of, infections that are occurring in our area. And if they lock it down, we'll lock it down. If they unlock it, we'll unlock it. And that's kind of my thought. I haven't put a whole lot of brain power behind that, but I think that would be a safe way. I certainly wouldn't want to be out in front of them.
Yeah. No, I get that. So what I'm hearing from you is conserve cash in these sorts of times. What about preparing for the future? And so I think most, and you could tell me if I'm off here, but at least in underwriting these and in my experience dealing with apartment operators, they prefer not to keep any more reserves than a lender requires them to. Maybe a month of cash flow plus whatever reserves the lender require. Does that change? Does 3 months worth of reserves now become not just a lender requirement, but a discipline that operators use? I mean, you're a military man who preparation is key to anything. Do you see that changing, or are we going to get 2 years down the road and everyone will have forgot about this, and cash will only matter so long as it's available?
Well, I think you've already seen some of that already be adjusted in the new debt requirements. Fannie Mae and Freddie Mac have already said if your loan balance is above this amount, then you're going to have to either have 12 months of principal and interest on escrow at closing, which is exactly what you're talking about. It's that cash. Remember, I said you need three things: cash, cash, cash.
Yeah.
So they're requiring you to bring those three things to closing. So now you're going to have 12 or 18 months, depending on the balance of your loan. You're going to have that day one. So if you have a loan, you're going to have 12 months of principal and interest. And a lot of times in multifamily investing, you would get a period of interest only. I believe that'll probably be thinned down. So there'll be a shorter period of interest only. You'll have to have a full year or a year and a half of that amount of payments, 12 or 18 months of payments, set aside in a bank account before you ever take the keys to the property. And in addition to that, you're going to have to monthly escrow taxes and insurance amount. So they withdraw that. So that's even going to increase your debt servicing even more. So what you just asked about, Spencer, I think has already been implemented by Fannie Mae, Freddie Mac. Whether that's implemented by the banks and private debt is yet to be seen, but generally they follow that guidelines. And so you ask, should the owner have to do that? No, the owner probably won't do it because it's a decrease in return, but it will be required to get the debt at a certain loan to value ratio.
Yeah,
So I believe that's going to happen.
Yeah,
that's already happened. That's already happened.
Well, those are really good insights. I think to finish, what I'd like to hear, and maybe we can go around the horn. Name one new expectation that tenants will have that maybe they didn't have 3 months ago. And I'll start so that y'all can think of of one yourself. But I wonder if there's an expectation that materials are different. And what I'm getting at with this is cleanliness is going to matter more. And Michael alluded to this with his funny example of the elevator button. But maybe the types of materials that we use that can be cleaned easier, both in our common areas and in units, will change. And I don't know enough about the composition of the materials and what matter, but I could see a trend where this sort of countertop or this sort of door handle is less likely to transmit disease, and therefore tenants will want that. In the same way that in this cycle, dog parks became a thing. Anyway, that's mine. Maybe I'm wrong, but that would be my guess. One area, Michael.
I think there's already a premium for it, but I think private entry is going to be a much more of a premium. People are going to want to have their own private entries in and out of their house. And they're not going to want to be in hallways, not going to be in elevators. And there's a guess, but I think that's going to be a trend that we're going to see.
Interesting. Lane, do you have any thoughts?
So I think that both of you guys are right on. So Spencer, I would categorize yours in a bigger, broader category as wellness. So you talked about cleanliness. I would say there's going to be more emphasis on the overall wellness concept. So inner air quality, inner environment quality, water quality, air filtering, and you said cleanliness, antibacterial, all of those things fall under a very broad category of wellness. And what used to happen would you would look at 3 or 4 apartment complexes, selecting which one, and you would think, these are all commodities. They're all equal wellness factor. But I think in the future, they will some way delineate themselves to say this one's cleanly or this one's more sanitary. We have procedures in place. We have materials here. We have inner air quality. And so what you're talking about, Spencer, I believe is going to stick with us. That's the wellness factor. Michael, what you talked about is you talked about a private entry. And what I would categorize that underneath is a contactless society. You're going to social distance. You're going to isolate yourself. You're not going to shake hands with anybody. And you're not going to come in contact with somebody when you can do things that don't require it. I believe that's going to stick with us, or at least some part of that will stick with us for a period of time. So contactless society, however you want to word that, and wellness. And then the other thing that I think is going to stick with us, and this is probably not the right umbrella to put this under, but I think it'll make sense, is just the changes and disruptions in supply chain. And what do I mean by that? Is I probably within the last year got carry out food 1 or 2 times. But going forward, there's going to be a lot of carry out foods, and there's going to be a lot of delivery foods. There's going to be a lot of groceries delivered to my house from Walmart or from Kroger or whatever. And I don't yet know how we're going to handle that, because Spencer, when you're at work and they need to deliver groceries to your house, are they going to put them in a cold storage? Are they going to open your door? Are you going to have some type of Internet of Things lock and it's going to unlock your door? But I think that there's a lot of tactical questions there that we haven't answered yet. But the change will be the supply chain. How will you get service, product, and merchandise to you? Are you going to go find it yourself? I think you will. That's not completely going to be eliminated, but a lot of it, you're going to find it virtually, and then it's going to be delivered to you in a different form or fashion. And that's going to change the way our real estate's used. It's going to change the way our real estate's accessed, and it's going to have implications.
Yeah. In conclusion, my final summary and kind of what I think needs to change and will change in the future doesn't really have to do maybe with some of the features and the different things you guys are talking about. To me, it's more the practical. It's more the communication aspect that goes between, lender to owner and owner to tenant. And I think I was reading earlier this week about a GP that just, he told his investors what was going on, but he did a very poor job. Now, when Lane was articulating his plan and why they need cash and what they're doing step by step, all those things, when you tell somebody, hey, we're going to stop reimbursement or stop disbursements and everything is staying in house, we're holding on to cash because of a question mark. If you say that and then you're following it up with because we want to be prepared, because we want to protect your investment and things like that, I think there's a lot of people that, because this is a new situation, they're not doing that. And so what do they say? With lack of information, people make up their own. And so there's a lot of potential investor confusion, and quite frankly, people don't create good information. No, that's not what we default to. We create bad information. So that relationship between investor, and owner, GP, LP, that whole dynamic there, I think there's some people that are probably doing a great job at it, and they'll surge because of this, both in reputation as well as future opportunity. And then I think some people, because of the way they communicated and their protocols and the way they carried out during this time, I think regardless of the performance of their assets, I think they are going to suffer greatly in the future because of just poor, inadequate communication. Okay.
Good point.
And I think the same thing happens from owner to tenant. Being reactive in that communication pipeline, like not letting people know your expectations, not letting people know what will happen in the future. What happens if this does happen again? You better not be on your heels for that type of situation, and your tenants better know where you're standing, because all of those things, the economy works because of people's confidence in purchasing things. That's what it is. It's human psychology at its fundamental level. And what most people are doing, they might be reaching up here in the branches, and we need to get down to the roots. And the roots is confidence. The roots is communication. The roots is being prepared. Okay. And I think whatever rung of the ladder you're at, and I know, I know people that are working for big companies, and those companies are saying, hey, let's model everything we have. That way we know where we're at. And now we can then communicate down the chain what our abilities and expectations will be. By the way, I'm guessing, I don't know this, but I'm guessing that those boys at the top, those big banks, they're probably getting that money from the government a lot quicker. Okay. And so if you're delayed down the chain, what's a way to accelerate your plan? Go up the chain that you can actually communicate with. So I think just in general, the communication part of everybody's going to really need to have an actual protocol up the chain and down the chain and understand what they're doing. And that way, when we get here, there's no question marks. That's what's I think unsettling to most people is just the question mark. Like, what are we doing? What happens if those ifs need to get solved, and they need to get solved quick? So that's it. Anyway, thank you so much for being here. And Lane, thank you so much for being here too. This has been absolutely amazing. And we will see you guys on the next episode.
Thanks for tuning into this episode of the Adventures in CRE audio series. For show notes and additional resources, head over to www.adventuresincre.com/audio series. Would you like to learn real estate financial modeling in a matter of weeks and do it with zero guesswork? If so, the ACRE Accelerator is for you. The Accelerator is a step-by-step, case-based program designed to teach you exactly what you need to know and in the order you need to know it, so you can gain both the knowledge and experience to take your career to the next level. To see if the Accelerator is right for you, go to www.adventuresincre.com/accelerator.